the reason why I wanted to run this training essentially is we have a lot of rookies. We got a lot of new faces on the team. Of course, super happy about that, but we want to make sure that everybody's on the same page as far as explaining how an IUL works, why does it work, how do we compare it to other things out there in the marketplace, and essentially know that we're doing right by people when we're doing this, right? So first things first, you guys have to kind of keep in mind is that an IUL, if you guys want to start taking notes on this, an IUL stands for Index Universal Life. Okay, so let's kind of break that down. What is an Index Universal Life? Okay, so Index Universal Life essentially means three things. Okay, so universal. Let's kind of break down the middle word, universal, U, right? That essentially just means permanent coverage. Okay, so realistically speaking, this policy will last their entire lives. Okay, the rate will be locked in at whatever age and health they are at when they got the policy, and it will never increase for the rest of their lives, right? The L stands for life insurance, right? And so of course the life insurance side is that death benefit, and of course we're gonna circle back to that here in just a second, but that's, like I said, the life insurance side to it, right? The death benefit and the advanceable death benefits, which we're going to go over here soon. And then the I stands for index, okay? Now, index is just a fancy finance word for matching, okay? So essentially, if I say I'm going to index the gold market, that means I'm going to match whatever gold is returning this year. If I'm going to index BlackRock, then whatever BlackRock returns this year, I'm going to match, right? And now, traditionally, an IUL, not always, right, because you can change the index, but traditionally an IUL will be indexing or matching the S&P 500. So the S&P 500 is the top 500 companies in the United States, and as if you guys want to look this up and fact check it, feel free, but it is pretty much considered over the last 100 years to be the gold standard for investments, right? Its average rate of return is 10% a year, which beats out basically anything else that's ever been done in the last 100 years. Nothing has returned 10% consistently, okay? Now, the reason why index or matching is so important, right, as far as like a notion goes, when it comes to, versus like directly invested, right? What's the difference between matching the return versus like putting the money directly in it? And the difference there is that instead of it being directly invested, that means that now it's susceptible to the full upswings, the full downswings, market volatility. The insurance company, the IUL carrier, gets to set the rules of engagement because they're copying it, right? It's not actually being invested. Now, of course, behind the scenes, whatever that company is doing with their money is between them and the company. And there are ratings out there, so you guys want to look it up. There's what's called fiscal ratings, so they can actually see, are you solvent? Are you, it's regulated, of course, right? So they're not just blowing their money and then these people will lose everything in their IULs, right? But at the end of the day, whatever they do with it, private equity investments, whatever, probably getting higher returns than the S&P 500 because they're not retail investors, right? They're doing private shit. That being said, right, with the money that's being matched from the S&P 500, since it is matching, they can set the rules of engagement. And so essentially when it comes to IULs, the rules of engagement are as follows. So first things first, the IUL, the actual amount is set at a 0% floor, meaning if the stock market crashes 30%, the IUL stops at 0%. You can never go negative, right? So whatever the amount of money is in your account for cash value can never decrease at any time, okay? And that's a really big deal because mathematically speaking, when I run through an example here, we're going to compare this to a 401k. If I have $100,000 in a 401k and the stock market crashes 50%, obviously most people in here are tired of me using this example, but if the stock market crashes 50%, how much money do we have? 50K, right? We all know that, very easy math. But what most people fail to realize is that if the stock market goes back up 50%, that you only have 75K. Because if you got 50K in your account now and the stock market goes up 50%, what's 50% of 50K? It's only 25, right? So essentially you have 75, even though the market went down 50% and up 50%, but you're still down 25 grand. And so this is why Charlie Munger, Warren Buffett, the greatest investors of all time, all have said the same rule, which is the number one rule in investing is don't lose money. And if you ask people around 2020, or you've asked people around 2009, or you ask people around these ages, right, where they were planning for their retirement at those ages, they were completely screwed, right? 5 years, 6 years, 7 years, 10 years, sometimes they had to wait for their portfolio to get back to a place where they could comfortably retire. And so an IUL essentially not only protects against the downside, it can give you the upside. Now, most IULs are capped, meaning you can't get more than maybe 8, 9, 10, 11, 12, 13, 14%. Okay. There are a few carriers that are actually uncapped, which isn't pretty incredible, if I'm being honest with you. They're harder to qualify for. But essentially they can get none of the downside and all of the upside. Okay. Before I go on to kind of explain IULs versus different types of life insurance and investment accounts, does anybody have any questions about kind of the nature of the index part? You can pause here for questions. Anybody has one? No questions? Okay. Keep it moving. Now, the cash value, right? When you hear this term, cash value, what does that mean? For a long time, I thought it kind of feels kind of scammy, right? Why don't just say cash? Is it value? Is it cash? Like, what is it, right? And what I've come to learn is that cash value is actually just essentially equity. That's all it is, just another word for equity. And so if I have $100,000 in a house, right, and that house is paid off, I don't have $100,000 in cash, right? I have $100,000 in equity. Now, the reason why that is such a big deal, and as you guys get more and more wealthy and you guys talk to more and more wealthy people, you'll realize that the wealthiest people in the world follow the buy, borrow, die method, right? They will buy something like a house, an IUL, whole life, a company, whatever it is. They'll make sure that it has actual equity, or it's an asset, it's something worth value. And then they will go to either third-party entities, or they'll go, for instance, with whole life and IUL, they'll go to themselves, their own carrier, and they will borrow against the equity that's in the account. Now, why would somebody do that, right? Why would somebody like borrow against their house, like take out a mortgage, or, you know, take out a loan against their business like freaking Apple did this past year, where they took out $1 billion, I think it was somewhere around like a $20 billion loan, when they actually have $50 billion in cash? Why would you take out a $20 billion loan if you got $50 billion in cash? Right? And the reason why these companies, these individuals, these wealthy people do this is because you essentially avoid taxes, right? If I am going to Amscot for a cash advance, or I'm whipping out my credit card, or I get a mortgage, or any number of things that has an interest rate attached to it, then all of a sudden it now legally is considered by the IRS as credit and not debit. So you don't have to pay any taxes on it. And so instead of having cash like this, right, where it's on hand, you're getting taxed, and here's the most important thing, if I spend it, then my money doesn't earn money like it used to. So what do I mean? If I have a 401k, right, like we just talked about, and I have 100K in there, and I pull out 95,000 of that 401k out of the account, I'm only going to earn interest on 5K, right? Doesn't matter if the stock market went up 100% that year. I'm really going to only earn $5,000 because I only have 5K in there. Now, if the same things apply to the IUL, right, where we don't pull money out, we just borrow against it. That means that even though I borrowed $100,000 out tax-free, that it earned interest on the 100,000. It stayed growing completely uninterrupted of its compounded interest. So the next year, even if I put in $0 next year and I earn my standard S&P 500 10% interest, that means I'm going to earn $10,000 in interest next year, even though I just borrowed $100,000 tax-free. Does anybody have any questions about that? Because I know that can be kind of complicated. Hopefully I made that simple, but I just want to make sure I touch base here. Does anybody have any questions about that?
Um,
Mm-hmm.
just pretty much like I had this one dude ask me the other day
Mm-hmm.
about like the cash value side and stuff like that,
Mm-hmm.
and he was asking like if he could take out a loan on it and then use that and buy another IUL or annuity and do it like that, and that one builds cash value and stuff like that, and just keep doing that and doing that.
Yeah, he can essentially. But that's a good segue into like why doesn't every single mother person and their mother have an IUL then, right? But outside of the whole, it's hard to qualify for. And the real reason why is that at the end of the day, this policy is kind of a Swiss Army knife, right? If I can build cash value at that rate and I have permanent coverage death benefit, there's got to be a catch somewhere. And there really is, right? The biggest thing to remember is that if I put in $100 every single month into this IUL, $100 is not going to cash value. Because if I die tomorrow, someone's still going to get a check for 100, 200,000 dollars, right? There has to be a cost to that because unlike every other type of life or every other type of insurance in the entire world, life insurance is the only one that is guaranteed to happen. Only one, right? And so I can't say I'm going to put $100 into this and now $100 going to cash value when clearly I have a death benefit. If I die at any point, my family is going to get a check for $100,000. There has to be a cost to that. And so, to answer your question, Cameron, yes, you can do that. However, every time you do it, you're kind of diluting your money a little bit because you're having to restart a new policy where a percentage of that is going into the cost of the life insurance. Does that make
Yep.
sense? Okay,
Yeah.
awesome. And so that's really why people don't always just do IULs versus traditional 401ks because even though, yes, the cash value side is growing faster, there's three things that impact compound interest the most. Okay. So if you guys want to write these down, feel free. The first thing that impacts compound interest the most is time, right? That's why you see like a 1 year old, a 2 year old with an IUL, by the time they're 65 with like $80 a month, they're a multimillionaire. All right, tax free. All right, first one's time. Second one is, of course, equity. So, what is the percentage that you're putting in every month that's going to that cash value? So, if I put in $100 a month and only $50 of that goes to the cash value, that means it's going to grow a lot slower than if I put $100 into a 401k where 100% of that is going to the 401k. Does that make sense? Right.
Yes.
And then lastly, the last most important thing is the interest rate itself, right? And it's what's the percent that you're earning on your money. Now, and those first two, and that last thing, the interest rate is so damn good in my opinion, because if the stock market drops below zero, you always have to double the rate of return of whatever you lost just to break even, right? If the stock market drops 50% and I lose 50 grand, now the stock market has to do 100% returns for me to get my money back. In our lifetime, how many times have we seen the stock market drop 30, 40, 50, right? But in our lifetimes, how many times have we seen the stock market go up 100?
Nope. Very rarely.
Right. Unfortunately, though, interest is the lowest factor traditionally when it comes to how much money you're actually earning. Okay. But we also have to factor in the back half, right? If I have a 401k, so let's compare it to a 401k real quick, right? 401k is debit, not credit. And most people think you don't pay taxes if you wait till age 59 and a half. That's not true. You don't have to pay a penalty, which is an extra 10%, but you have to pay taxes. And not only do you have to pay taxes, but you have to pay taxes at whatever income bracket you're at when you pulled out the money. So if I have $200,000 I pull out at age 59 and a half, then my income for that year is 200,000. Therefore, so is my taxable income for that year. That's a much higher tax than when you started putting the money in.
About 30%.
Right. And then on top of that, is taxes going to go up or down by the time we get to age 59 and a half based on the history?
Oh,
Exactly. And so I just want to kind of remind you guys that we really are helping people, okay? But with that being said, though, the most important thing to remember is that this is life insurance first. because the percentage of equity isn't always able to go toe to toe with a 401k or Roth IRA, specifically just because of the fact that it, of course, doesn't all go to cash value. But when you factor in the taxes, when you factor in, of course, the fact that you have life insurance, and let's go over the last thing, you have advanceable death benefits. This truly is an incredible product, right? It is a Swiss Army knife of insurance. And what did I mean earlier when I say advanceable death benefits? Well, essentially, the IUL has it built into every policy that if something happens to you where you can no longer take care of yourself anymore because you can't drive to work, you're a vegetable, you can't dress yourself, whatever it is, right? And it does change based on how little you can take care of yourself. But if you do that, or let's say it's, I can't drive to work, maybe 20%, but if you're like a vegetable and you're still alive, they will give you up to 80% of the entire death benefit up front as a lump sum check, just like Aflac. That's pretty damn crazy. All this is in one policy, you guys. Okay. Now, with that being said though, right, let's go over how does this compare to term and whole life. So before I do that, just want to double check. Does anybody have any questions for me? Because again, I know I don't really have my visual aid up here, so it could be a little bit confusing.
Now, like I've heard you talk about like you could choose like the death benefit versus like the actual cash value side. So like what's the lowest cash like or the most cash value you can do with the lowest death benefit?
Yeah, really good question. So there's multiple ways to structure a policy, and let's actually talk about that real quick. It's a little bit advanced, but I don't mind. So essentially, I'm going to paint with broad strokes here. Okay, I just want to reiterate this to everybody here. The amount that goes to cash value is dependent on someone's health, someone's income, what carrier they're with, their contribution amount, what their death benefit is. There's a lot of factors that play into how much is going to equity. Okay. That being said, I'm going to paint with broad strokes here so you guys kind of get the gist of it. Okay. And that is if you do the normal solve, right? Meaning like you see 80-90% of our policies are, right? We're just, here's the premium, this is the death benefit, yada, yada. It's about 50%. Okay. So 50% is going to the equity, 50% is going to the death benefit. Now, if I structure it where you might hear this term in the future, it's called minimum face maximum funded, or min face max fund. And essentially all that just means is that you're now structuring it so that 80% of the premiums that you're paying are going to cash value and only 20% is going to the cost of the life insurance. But as you can probably guess, does anybody here have a good guess for me what happens to that death benefit?
Really, really low.
Yeah. And, really low, but it drops pretty significantly, right? Because now a higher percentage is going to cash value. And then we can even take it up a further notch, which is called minimum face, maximum funded, with an increasing death benefit. So what do I mean by that? Well, essentially the IRS says, hey, look, we love the fact that this is an IUL, it's life insurance. That's why we're not going to tax you, on the income. We're also not going to tax you on the death benefit payouts here. But for it to still be legally considered as life insurance and not an investment vehicle like a 401k or a Roth IRA or any of these other vehicles, essentially you need to have a death benefit that is always higher than the cash value. The cash value cannot exceed the death benefit. Otherwise, this is no longer legally considered life insurance. Okay? And so when you do a minimum face, maximum funded policy and you structure it with an increasing death benefit, what you're essentially saying is the very first year of this policy, I'm going to have the absolute lowest death benefit possible for this amount of money, right, that we're contributing. And then every year as the cash value increases, so too does the death benefit, but just by a little. So it rides this line that the IRS deems as legal and not taxable. Does anybody have any questions about that? And that's 90-10 split.
And that's like the absolute lowest you could go.
Correct. Now, I've had a lot of agents, even just recently, kind of more or less question the way that we sell the IULs here. And I want to clarify that because I want to make sure you guys know where I stand on this mentally. But I also want you to know that this is your business and you can run it how you want, right? I'm not going to judge people because at the end of the day, if we were to be completely 100% transparent with every person about exactly every little detail of every little policy, and then they made a decision, not a single person would ever be insured, because to get through that entire brochure would take 4 hours, right? And
Yep.
so every person is going to have to define for themselves where they believe the moral line is as far as explanation goes. I personally believe that as an expert, a financial expert, that it is not my job to actually explain this to you. It's not my job to educate you. It is my job to hear what your goals are and what your problems are, and then to find you a solution that's going to fix it. Right? Because I know what I'm doing, so morally that's my job. But for you to understand it is not necessarily my prerogative. It's great if you do, but that's not my priority. And so the reason I bring this up to you guys is because if you actually get and start playing with, I saw in the group chat earlier, people were playing around with illustrations. Illustrations is essentially just showing the projections of their income year by year, right? Their cash value, their death benefit, all that. And so there's a good amount of people out there, even agents who sell IULs, that believe that every policy should be structured minimum face, maximum funded. Okay. Now I respectfully disagree with that. And the reason why I disagree with that is for a few reasons. So I'm going to kind of tell you. So first is that in the case of the average premium that we sell, right? The average policy we probably sell is maybe 100 to 150 a month, right? And so if I'm putting in such little money, right? Remember we talked about the second rule, which is how much is going to equity. So if only maybe $75 a month, or instead maybe it's min face max fund and now it's $100 a month, is going, that's a difference of $25. And so if I look at that over the course of 10 years, that's a difference of like $10,000 in cash value over 20 years, right? It's the difference is very minute. However, if I look at the death benefit of those policies, typically that's a difference of bare minimum $50,000, but more likely it's like $100,000 to $200,000 to maybe even $300,000 is the difference between minimum face maximum funded and the normal easy solve policies. And again, you're like, Zach, well, what if they ask for cash value? But like, again, the people come into the doctor's office all the time saying my foot hurts, and they don't realize that it's really a nerve pinch in their neck, right? It's the same thing. I'm the expert. So you tell me you want to protect your family. You tell me that you want to also build a business. You tell me all these things. I'm going to try to find something that can give you as much of it as possible. But, at the end of the day, if we're sacrificing not just a huge death benefit, right? 100,000, 200,000 plus, we're also sacrificing an advanceable death benefit. Remember, that extra 100, 200,000 is there if you need it, which is 80 to 20% of that death benefit. So you're sacrificing the advanceable death benefit. And then on top of it too, if you decide, hey, Zach, my business is doing better, I got a promotion, I got a little bit of savings, whatever it is, I want to put more money into this IUL, the only way for you to do that is for you to actually increase the death benefit. Because like we just mentioned, the ceiling and the cash value are running parallel to each other when you do minimum face maximum funded, right? And so if I want to put more money into this, I can't. I have to actually increase the death benefit. So if 5 years down the road, 10 years down the road, whenever this person wants to pour more money into it, I have to be the bearer of bad news and tell them, you have to get underwritten all over again. You have to get your medical records checked all over again. You have to, you know what I mean? Like you have to go through this process. And if it's 5, 10 years down the road, do we get healthier or unhealthier as we get older?
Unhealthier.
Unhealthier, right? So as you can imagine, we're running a huge risk that at any point this person can't put more in. Whereas Frankie cleanly puts it, when we put it like a normal easy solve, we're giving them the option to overfund the policy by at least about 0.9%. Meaning like if it's $100 a month, I can throw in another $90 a month. If it's, and again, I'm painting with broad strokes here, but if it's $500 a month, then I can put an extra $400 a month. Does that make sense to everybody?
Yes.
Cool. Now, once you start crossing the threshold of about $500 or more, that is when the math of this really starts to make sense as far as structuring this for minimum face, maximum funded. So I don't mean that like forever and always, they tell you they want cash value and that's all they want, and you just fuck them over by doing death benefit, right? Max of it. I'm not telling you that. But I am telling you is that most people hear the word cash value, they think of this like buzzword, be your own bank, and then they try telling you what they want while also saying, I have to protect my family. I need to make sure this is covered, the advanceable. I need like all these other things, right? And so at the end of the day, you have to kind of make that determination yourself on each call and determine that like this person, even though says cash value, like there's this is not going to actually be the best fit for them. And it's my job to pick the best thing for them. And hopefully you're educating them along the way. But again, that's not your main job. Your main job is to solve their goals and their problems. And if you think you've done a great job doing that, then of course you can leave it at that. Okay. Before I go any further into kind of explaining cash value, the index, universal life, all that stuff, I'm going to go into comparisons now with term whole life. Does anybody have any questions for me?
No.
Zach, I got a quick question.
Yeah, what's up, man?
Take too much time. Maybe we can do it one-on-one.
Mm-hmm.
But I was wondering if you could maybe pull up an illustration and see if there's any way that you can kind of simplify what we're looking at when those here, because I've had a lot of clients ask me to send them those illustrations of what it looks like 20, 30 years down the line.
Yeah.
And because there's a few things on there that obviously I don't really understand it because I never dove into it like that. And I guess that kind of goes along with the question. Jawad was nice enough to answer my question. I think it was last night or the night before, where the question was, you can't borrow more than your death benefit, right? But
Correct.
what is the, obviously at some point, if you're young and you hold it for 4 years or whatever, you're looking at like $800,000 or $900,000 or something like that after a while. So is maybe you can kind of clear that up for me in terms of like, can you borrow all of that, or because then more than likely that's going to be more than the original death benefit, right?
So to clear this up, you can only borrow the amount of equity that you have built up in the policy. So if I have $10,000 of cash value, that's the max I can borrow, right? Until next year when I earn another 10% interest and then I have an extra 1,000, right? Then I can borrow $1,000 next year.
Okay.
Right. But if I want to, I can do one of two things. I can either one, pay myself back, right? Because I'm my own bank and I can choose to do that. Or essentially I can choose never to pay myself back, which a lot of people do because there's no monthly compounding interest rates going against you, right? Like you would if you borrow from a third party entity. And so if you don't pay yourself back at the end of your life, it will then be deducted from the death benefit. So your death benefit is essentially the collateral, right? If I have a house worth $100,000, I take out a mortgage worth $100,000, I don't pay the mortgage off, they keep the house, right? The death benefit is the collateral. And so that's why you can't borrow more than the death benefit. But a more accurate statement would be you can't borrow more than the cash value, because I can't pull out $100,000 if I've only contributed, I only have 10,000 in there in cash value. Does that make sense?
So that massive number that we see towards the end of the policies is really just, you can only borrow a percentage of that, like the equity of that big number.
The big number is the death benefit? Is that what you're saying?
Well, maybe once you pull up the illustration, it'll...
Sure. At some point later on in life, essentially your cash value will actually catch up to the death benefit. So then if I wanted to borrow the entire death benefit, I could. Does that make sense? But you can't borrow more than how much cash value is actually in the account. Eventually, if I structure it min, face, max fund like this, eventually it's going to be like $100 behind. Like the cash value is going to be like $100 always behind the death benefit. Does that make sense?
Hey,
I'm going to show you guys here in a second. Yep. I think we had 2 questions. I saw Jake raise his hand and Romario. What's up?
oh, never mind. I think you just answered it.
Okay.
Okay, so my quick question on it was, let's say for example, you have a death benefit of like $200,000,
Uh-huh.
and you've accumulated like 20,000 your cash value, borrow 10K from it, and let's say you died a month after, right? Knock on wood.
Yep.
Your beneficiary would just receive 190,000 because you took 10,000 from it, and that's the collateral if you didn't pay it back.
You nailed it. You got it.
Perfect. All right, gotcha.
Oh, Zach, sorry.
You're good.
You can only borrow the equity in the cash value, right? So like, you know how like part of your premium is going towards the death benefit as well.
Correct.
I heard from someone before in the past that it's like the total amount of premiums that you paid,
Yeah, no,
but
that's
that would be different. That would be more than what the equity is.
exactly right.
Okay.
And it also depends on how you structure it, because if I structure it minimum face, maximum funded, and I do an increasing death benefit, now it's closer to like 90-10. So about 90% of it, of the premiums you're paying, are going to be is cash value, is equity.
Yeah, with the min face max fund.
Yeah. So I'm going to show you guys a minimum face. Oh, I don't know why it won't let me run a report here. One sec. One second here. I'm going to do it at 300 a month because I don't know why it's being weird right now. And then option B, maximize cash value. It keeps switching to max. Sorry guys, one sec here. Okay. There you go. All right, so this is America. This is one of the carriers that we offer. I'll scroll down here. And as you can see, guys, this is why I'm going to leave each and every single one of you to determine it for yourselves. Now, to kind of go back here, of course, as you guys can see, the age is a 40-year-old male. Men are more expensive to insure than women are. We don't take as good of care of ourselves. Nicotine use, of course, is no. If we did yes, it would be a much higher cost of life insurance. The face amount is $449 a month. The death benefit, as you can see, is very low. It's $100,000. I put it here. I don't know why it keeps switching back to basic, but I've already calculated it, I believe, for men maximum face. It just keeps glitching out on us here. And then option A, level death benefit. Option B, an increasing death benefit. So I structured this essentially for the 90-10 split. Okay. And this looks about right. So let's go through here. Where is it? There we go. All right. So as you guys can see here, by the way, real quick, there's 3 different illustrated values. So illustrations, actually, I'm going to run this through with you guys how I would essentially run it through with a client. Okay. So Mr. John, as you can see here, this of course is going to show you your policy. And so as you can see here, this first column that you see at the top, it says guaranteed interest rate of 0%. Now, Mr. John, like we just talked about, this is indexing the S&P 500, right? As you saw when I showed you here earlier, S&P 500, right? So the S&P 500 essentially is the one earning the interest on this account. So Mr. John, over the course, this is showing you that basically over the course of your entire life, if you got a 0% return because the stock market over the next 20, 30 years is either earning negative interest or earning 0% interest, this is what your returns on your money would look like, Mr. John. So I just want to make sure I let you know this. At the end of the day, of course, I'm glad your money would be safe here. As you can probably imagine, though, if the stock market is earning 0% interest for the next 20 years, you have way bigger problems than your IUL. The world is on fire. Okay, we're in the apocalypse. If over the next 30 years you're gaining 0% interest. So just kind of keep that in mind. This is next to impossible for this to ever to happen. So what I am going to show you though is what their non-guaranteed, of course, right? Because the guaranteed is 0%, but the non-guaranteed interest rate, meaning this is what their projections really are. They have 2. So one is a conservative estimate. As you can see, it's almost half of what the actual interest rate is in the stock market. And the other one is a little bit more closer to that 10% interest of 8.4%. So if we look at here, you can see the end of your policy year 1, right? That shows you every year of the policy, year 1, 2, 3, 4, 5. Shows you your age, which would be 41, 42, 3, 4. And then it also shows you how much you're contributing to the policy, which is 5,393, Mr. John. Okay. Now, remember, like I mentioned to you, we structured this for minimum face, maximum funded with an increasing death benefit, which essentially all just means is that 90% of the premiums that you're going to be paying on this policy are going to actually go to cash value. The other 10% are going to go to the cost of life insurance. So, Mr. John, if we were paying, what was it again? Was it $400 a month, 430, something like that, or 450? Only 10% of that, meaning like $50 a month, is actually giving you $100,000 of death benefit. Pretty cool, right? It's pretty cheap for $100,000. On top of that, it's permanent, right, for the rest of your life. Now, as you can see here, though, the cash value, this is the accumulation of 4,700. This one right here is a little more accurate. It's at 4,708. Now, the reason why they don't show you 10%, Mr. John, is because they're liable. If it were to show you 10% and they don't give you the returns of 10%, they are liable. So they have to show you a conservative estimation, okay? Now, the cash accumulation right here is $4,708 in this category. And as you can see, the death benefit is also $105,161, okay? Now, you might see this column here. It's called surrender value, okay? Surrender value just means how much of this equity is available for borrowing today, okay? So just like I have a house, if I have a house worth $100,000 and I go to the bank and I say, hey, bank, I want to take out a loan, they are not going to give me a loan for $100,000. They're going to give me a loan for $80,000, right? They're going to give me a loan for 80% of whatever my cash value is. Okay. It's the same thing here. So every year you'll notice now it jumps up from less than 2,000. Now it jumps up to 7,000 to this 9,800, right? Now it's 12,000 and 15,000. As you can see, after a certain amount of years, right? So let's see if we can find that year. I believe it's right here. By year 15, you will now have 100% equity available, Mr. John. Does that make sense to you? Do you have any questions for me there? Okay. So if not, as you can see, we're at age 55 now. Let's go to the traditional age of 65, right? At this point, as you can see here, we're still contributing that $5,000 a year, but now we've hit interest rates where essentially we're earning so much interest that every year, as you can see, we're going from 354 to 387. So we only contributed 5,000, but we got an additional essentially $25,000 in interest alone every single year afterwards, right? After age 65. And the most important thing to remember, John, is that if I decide on my 65th birthday to give myself a big old retirement party and pull out $300,000 and go blow it, right? Or maybe I go have a midlife crisis and I go buy a motorcycle or a boat. The cool thing about it is that, Mr. John, as you can see, that this is equity. And so essentially, if I borrow that whole $300,000 or $350,000, that's first going to be tax-free. But second, and most importantly, I will still get the interest on the $354,000. Meaning, even though I'm pulling money out of this, the next year I'll earn it. So if I pull all of this out, the next year I'll have another $25,000 in just interest alone that I can pull out, tax-free. So, Mr. John, do you have any questions for me on how that works? Okay. As you also can see here, your death benefit is also increasing in value. So if we scroll down to the average death of a male in the United States right now is 82 years old. So if I go to 82, as you can see right here, my cash value has now jumped up to $1.6 million. And on top of that, as you can see, my death benefit is now a clean $1.7 million. So when you hear people talking about generational wealth, this is what they're referring to, because most people's wealth is lost in 3 generations, Mr. John. And as you can see here, not only would you be set up, but you're probably going to set up your kids. And of course, because your kids will be set up, your grandkids will also be set up, essentially breaking that curse and leaving true generational wealth. So, Mr. John, do you have any questions for me on how this IUL works? Does anybody else have any questions? Not Mr. John.
No.
Cool. Does anybody kind of like what we're seeing here? This is what we're selling to people.
Oh, hey, can you hear me?
Did you got that just at the application right at the bottom in the middle, right?
Yep.
You
You
just
click
clicked
report.
on the report.
Yep.
Okay, awesome. I'm gonna check that out later.
I want to let you guys know this now. If you feel like to make a sale, you need to pull these reports, you are sorely wrong. I promise you deals will die in the details. And so that is why we don't sell this as an investment. We sell it as life insurance. And if you want to overfund it, you can do so. You want to put more into it, you want to help it grow, all this stuff, great. But people buy on emotion, not logic. So we're going to pull on the heartstrings, and it just so happens to be that it's an incredible product. But we don't need to explain to them why it's an incredible product. We just happen to be doing right by people. But if you try to explain that to them using logic and facts and figures, they won't believe it. Or if they do believe it, they'll compare it to something else, or they have to think about it, or whatever. It's just adding details. And you are an unreliable narrator, so as long as it's coming out of your mouth, it will never be fully 100% believable because you are the ad. You're the person who wants to push this. I've made that mistake many, many, many times. Cool. Now, last thing I want to do real quick, guys, is compare this IUL with a whole life and a term life. Okay. So again, go ahead and bust out those pen and papers real quick. Let's make sure we have a good, solid understanding of how this works. So the first thing to remember is that a term life, kind of how the name sounds, is it's temporary coverage. Okay. So term will last for 10, 20, up to 30 years. I'm not going to go over, I'm going to end the stream here because you can run quotes on it whenever you'd like on your own. But essentially, term is temporary coverage, okay? And if you Google it right now, feel free to fact check me here. Term life insurance is over 98.9% of term policies never pay out. You're like, what the? Why would anybody get that then? All right. And the reason why is because it is the cheapest for the best death benefit possible. So wealthy people who have assets that they can also take loans from, or they have a trust that avoids probate and the government, taking their assets and divvying it up, and it takes like 4 to 6 months and all this craziness. They will often get term to protect their mortgage or protect like an asset. Okay, so it's the cheapest for the best premium for the best death benefit. But essentially it only lasts for 10, 20. The longest one I've ever seen is 40-year term. Okay, and the underwriting is almost identical to an IUL, which means you essentially have to be super healthy to get it, just like an IUL. And if you're really healthy and it's only temporary, that means they know that statistically that's why they outlive it. Okay. Now also, because term is temporary, it builds no cash value. Okay, you can't borrow from it, can't deduct from it, nothing like that. It's just there for life insurance and life insurance only, except for it has advanceable death benefits. So my USHA people here, we know term. We wrapped it all the time. We called it MedGuard, right? And those advanceable death benefits is what allows people to pay bills, pay off debt, take care of their families, whatever. And that's what term has. That's why many times when somebody says, oh, I got employer coverage with life insurance, 99% of the time it's a term, and it only applies to them while they're still at that job. And the reason why they even have it for the employees is so that, of course, that advanceable death benefit works like disability insurance. Cool. Does anybody have any questions about term? Yeah, go ahead.
No, we're good. We're good. I'm just, I'm retarded, so it just takes a second for things to click.
Oh, you're good, bro. But yeah, if you have questions, just interrupt me, no problem. So then the next thing is whole life, right? Whole life is the exact opposite. It covers you for your whole life, right? It's permanent coverage. And because of that, that rate is now locked in, meaning just like the term, right? Just like if you're renting a house, after a while, it's going to expire. You're going to have to get a new rent at a new house, probably for more money, or renew your current term or renew your current rent for a higher price. And so whole life locks in at whatever rate you're at. So if you're in your 10 years old, right, and you get whole life, the death benefit's going to be ridiculous, super high. You know, you're going to build cash value early, and it's going to be locked in. So it's a big deal. And so whole life, of course, covers you for your entire life. However, the only advanceable death benefit that a whole life has is essentially the terminal illness, meaning you are on your deathbed, you are in the hospitals. Yo, I'm running the training.
Oh, okay.
Yeah.
I'm just gonna send you some Airbnb options. I'm booking an Airbnb for September, so I wanted you to see them. Okay.
Yeah, no worries. Yeah, just let me know later. I gotta finish this training here.
Oh, you're good.
All right. So it only has the terminal, essentially like 30 days before you actually die. You're in the hospice, right? And then, of course, because it is whole life, it covers you for your entire life, and it does build cash value. Now, again, the percentage of equity, how much is going to equity, is going to be dependent on the carrier. It's going to be dependent on your health. It's going to be dependent on your income, or I'm sorry, on your age. So I can't give you a broad strokes term, I can't give you specifics, but I can say broad strokes, it's about 20% on average, meaning only 20% of what you're putting in is actually going to cash value. And essentially, the reason why is because the underwriting is so lenient and because it is, of course, permanent coverage. Unlike a term that expires, this is going to be designed to be there for your entire life, which means it's like you go into a casino and eventually they know you're going to hit big. They don't know when, they don't know how, but you will hit big soon. They're going to have to charge you more. Whereas term, there's a very, very, very high likelihood that you will never win big. Does that make sense to everybody here? Whole life? Cool. All right. Now, as far as whole life goes, again, it can build cash value. You can borrow from it. It comes out of the death benefit, all the same thing. But that interest rate is typically around 3 to 4%. Okay. So one thing I want to make sure, though, I keep in mind with all of you guys here, you guys are clearly hearing this and going, wow, IUL is much better. But when we pitch it, that is why we pitch life insurance, not death or not cash value, right? It's an afterthought. And the reason why it's got to be an afterthought is because if they still need to have their family covered and they're sold on the cash value side, we don't want to lose these people, because real talk, guys, when we talk about we don't want to lose them, I know it's very easy to think, okay, we're talking selfish here. We want the money, we want the commission, don't let them go, close everybody. But if I were to sell you fire insurance on a house, let's say you own a house and I say, hey, I'm going to sell you fire insurance. And I say, oh, hey, by the way, it's already burning down right now. It's burning down, but I'm going to sell you fire insurance. Who here would take that? You'd be like, no, I mean, like every single one of you hopefully would take that, right? You're telling me I'm buying fire insurance on my property and it's currently burning down. So when it finishes burning down, I'm going to get paid out. Yeah, that's what I'm telling you. And essentially that's what we're doing right now. It's just our bodies are slow burning houses. But we're dying, all of us. And so if we're going to sell any sort of insurance, even health insurance, it's just because something might happen. Life insurance is the only one that is guaranteed. And if you guys look this up right now, you can see whenever the unemployment rate changes by 1%, an average of 21,000 people die in the United States when the unemployment rate changes by 1%. And so I hopefully you guys can hear the gravitas of what I'm trying to say here is that, like, these people, every single human who is alive needs to have life insurance. The only way you don't need it is you are ultra wealthy and you have a trust fund. Everything else is going to go through probate. And so if your family is not going to receive a tax-free check within a few days of you dying, you are leaving a huge burden to that family. You're potentially making them go broke, you're putting them into debt, and you are actually ruining your bloodline. The generations after you will struggle because of your selfishness. versus the opposite, where you can set up people, where you can make sure that your family is protected. And if you were to pass away, they have money to actually jumpstart their lives. They have a legacy that they're able to take from you and take it further than you took it. And so I'm just telling you guys, like, I care so much about this because there is nothing out there that does that. Other than an irrevocable trust, there literally is not. And there's like, or costs like 20 grand to set up. So with that being said, I don't want, when you guys pitch this, I don't want you putting IUL here and whole life here. It's here. We have to make sure that these people know that that we both agree you still need permanent coverage that's going to, of course, be there when you need it, and of course is going to make sure your family's taken care of and you have cash value. And here's a quick little fun, cool part about this. Even though it's building a small amount of cash value, that cash value over the course of the next 10, 20, 30 years, however long they have it, is going to be enough cash value that essentially, if they are in their late 80s or 90s, who here thinks that they're never going to miss a payment on their Netflix when they're in their 90s? Right? And so if you miss 2 premiums back to back on a term policy, you are losing that policy. It's gone. But if it's whole life, right, and that's been building cash value, or it's an IUL that's been building cash value, and you miss 2 payments back to back, they won't cancel everything that you've been doing. They will just pull that from that premium from the cash value. So you have a policy that is insuring itself. It is making sure that it is there when you need it. Because if you're getting into your late 80s, you're probably going to miss a few payments here and there. You know, hopefully we'll all be sharper, but who knows with technology. Cool. Does anybody have any questions for me? Okay. Now, like I said though, last little bit of this, IUL is the best of both.
Oh, sorry, I was muted. I had a question.
Yeah,
My bad.
Go ahead, Romario.
Yeah, I was asking. So, as you were saying, like for an IUL or whole life, they're in their 80s and they miss a payment, you can go towards it. Is it the same thing? Let's say they have the policy for a year and they've built enough cash flow and they missed the payment. Could it be just rolled into it and pay for the premium and it doesn't get like lapse and get a chargeback, or it has to be until like a certain time period?
So as far as like lapses and chargebacks go, that's always based on the amount that you are advanced, right? So if you're advanced 9 months and they cancel the first 9 months, then it's a chargeback, right? But essentially, once it makes it past that first 12 months, not only you're not getting a chargeback, you're not getting an as earned cancellation, right? After that, if they cancel, then like it doesn't have any effect on you, right? But as far as the cash value goes, I'm going to answer your question how I answer everyone's question as far as clients go, because I want you guys to answer it the same way. And that is so you can avoid opening Pandora's box and doing what we just talked about, which is this illustrations, right? Because deals die in the details. So if somebody says to me, okay, so if I put this much, or like when can I pull it out, right? You'll hear that all the time. When can I start borrowing this? When can I start pulling out? And it's very easy. You say it with confidence. You just say, oh yeah, I mean, well, it just depends on how much you put in. The more you put in, the faster you can pull it out. And so, of course, and that's the truth, right? If I'm putting $1,000 a month into my whole life, as we just saw from the illustration, right? Then that first year, I mean, I only had $1,000 to pull out. But if I was putting in $100 a month, I probably wouldn't have anything to pull out, right? But essentially, if we get into the details and we open Pandora's box as far as, okay, so if I put in $105 a month, then how much do I get? And I promise you, you're not going to make the sale. It's not going to happen. And essentially, it doesn't even matter. Like, it's not about making the sale. It's about helping these people, right? And too many options will confuse them, will make them not make the decision and not do what's in their best interest. Cool. Does everybody feel like they have a much better grasp now on kind of the 101, like what is it that we're doing? What are the options out there? Cool. Last little bit, because we got 4 minutes here before I got to hop in my one-on-one trainings. Last little bit here, just to keep in mind, is essentially if we compare this to other investment accounts out there, I just want to make sure you guys know that, of course, what we're doing is incredible because we're offering products that offer no downside and upside only. But obviously I want to make sure you guys know that when it comes to other investment accounts, 401k, Roth IRA, really any of these traditional accounts, this is a personal opinion. This is not this is not financial advice. This is a personal opinion. I personally believe that even though you could make the argument that a Roth IRA and an IUL and all that stuff is financially going to be a little bit growing a little bit faster, you're overlooking the fact of timing, right? If I say, well, this thing if I take the same amount of money and I put into a Roth IRA, by the time I get to age 65, I'll have, 2 million instead of 1.6 million, Zach. Like, that's an extra $400,000. Why would I not do that? And I would say that's because you're assuming that when the money is in there, that you're going to time the market correctly and you're going to pull it out at the exact time that money should be there. But if you were to try to pull it out in 2009, or you were to try to pull it out in 2020 or 2019, whenever that crash happened, if you were to try to pull it out at that time, you would have had to wait. On top of that too, tax penalties. And then the last thing, and this is probably my most important thing, I think, is with an IUL, I never have to check my account and wonder if it's going to be half gone today. And so I personally believe that we used to live in the world of pensions, right? Who here remembers like their parents saying, you need to go to college so you can get a pension? Remember that?
Yep.
Right.
Yep.
Pensions are gone. Right. And now, of course, so is the college system. But it's because pensions are gone, they replaced them with 401ks. Pensions were guaranteed retirement income. 401k is nowhere close to guaranteed. Not even a little bit. Right. We're seeing that after me explaining it, the taxes, the penalty, right? The loss of interest because you pulled money out of it, and you're holding on to it till age 59 and a half. And I personally believe that the world that we live in now, with hyperinflation, right? With people all having 2, 3, 4 jobs, people having side hustles and entrepreneurism, and essentially the traditional nuclear family not really being able to survive like it used to, right? If you go and look back, minimum wage back in like 1960s, which was when people could literally buy houses with minimum wage, for it to be minimum wage now to be able to afford a house, instead of it being, I think it was like $3 an hour, with inflation, it's now $66 an hour. You'd have to make $66 an hour to be able to have minimum wage afford a house, right? And so this world that we live in, guys, is the separation between the haves and the have-nots is growing faster and faster. So me personally, I think it's better in the world that we live in now to put people in a situation that if they need the money for an emergency, right, or they have an opportunity like to launch a new business, or they have an option to put capital into something else, that they don't look at the account one day and see it's gone. So I would much rather, me personally, have a little bit lower on the downside or on the upside to make sure that I have a war chest that's always available for deployment, versus one day checking and seeing it's gone.
Yep.
Because there is no borrow, or there's no like save money until you die thing. That doesn't work anymore. Inflation's at 7%. Checking accounts are offering 1%. Cool.
If you're lucky.
If you're lucky. All right. Does anybody have any questions for me on today's training session? Everybody feel a little better about what we're selling, a little more conviction, so that when we realize that when we're letting these people off the phone, because maybe we haven't read How to Win Friends and Influence People, maybe we haven't taken the time to book enough training sessions with Zach, or Shadow Enoch, or Shadow Jawad, or Shadow Chuck, or all these people that are killing it. If we haven't taken the time to get good at our craft, then we are essentially letting these people miss out on one of the best products in the entire world, that is the only insurance in the world that is for the guaranteed thing that's going to happen, which is you're going to die, and it can build cash value and essentially protect you while you're still alive as well, right? Like, we're doing these people a huge disservice by not being good at our craft. And so I hope that in this next coming week, 2 weeks, that you guys really take the time to book training sessions, to shadow people, ask questions, and do everything you can to make sure that these people do actually get this thing that is probably the most selfless and responsible purchase of their entire life. Cool. Does anybody have any questions?
No.
All right. Well, guys, with that being said, let's get after it. It's the second half. I know it's Friday. I'm sure some of you guys are wanting to hang out. However, let's go ahead and let's finish strong. It's not how about you start, it's how you finish. I'm going to throw out another little spiff here because we didn't get to the dial one, just a crazy morning. So I'm going to do $50 for the next deal in the day. So whoever gets the first one, it's $100 if you guys close a deal for a live transfer person. Okay. So let's go ahead. Let's get after it, guys. I'm excited. Second half, let's get at least a few more on the board. I'll see you guys.
See you.
Hey, Cameron.